Good morning and welcome to the sixth session of the Shepherd and Wedderburn Rural Disputes Group Coffee Break webinars. For those of you who don't know me, I'm Alexandra Smith and I'm an associate at Shepherd and Wedderburn in the Rural Property team based up in Aberdeen. During this morning's session, I'll be discussing the particularly thorny topic of family farming partnerships, how to avoid fallouts, how to deal with them, and if, or unfortunately, in many cases, when they do occur. Many farms in Scotland are farmed by family group businesses who work together in partnership, whether harmonious or not. In Scotland, a partnership has a separate legal identity. It can own property, it can be a debtor, and it can enter into contracts with its individual partners. Even although Scots law partnerships have these attributes, any change in the membership of the firm means that a new firm is created. However, if the business being taken over by the new firm is substantially the same as the old firm, it takes over the whole liabilities and assets of that old firm. In essence, the new partners take on the responsibility of the old partner's actions. Already you can see the potential for a variety of disputes to arise simply because of the nature of the business. The mere fact that the parties involved in farming partnerships are often family members means that there is a particularly sensitive and therefore ultimately contentious area of our practice. There can often be power struggles between parent and child, between siblings, or even in some circumstances between spouses who are all in partnership together. In the majority of cases, partners fall out with one another simply because of lack of communication. Frank, open conversations that could address underlying issues are simply not had, whether that be due to a lack of time, the inability of the family head to pass on the responsibility, or because of the reluctance to have those difficult conversations. Issues that are never addressed will invariably cause resentment between the partners and therefore result in a partnership fallout at a future date. It is of utmost importance, therefore, that the partners should make time to have these open, transparent, and as I said, sometimes difficult conversations to settle and address any underlying concerns before they fester and become something into which cannot be later fixed. Although perhaps such conversations are best not had around the Christmas dinner table. So how are partnerships created? There are two ways essentially in which partnerships in Scotland are created, and the first is by virtue of a written partnership agreement. The agreement should, amongst other things, contain some of the following provisions. Firstly, it should detail the assets belonging to each party. This is extremely important if, for example, one partner has purchased an asset from their personal savings, but that the partnership has thereafter used that asset in the course of the business. That could include anything from a vehicle to a piece of machinery or even as far as to land. If the agreement does not specify that that certain asset belongs to the individual partner and it's reflected in the partnership accounts on the balance sheet, then it may be construed that that asset belongs to the partnership. If that partnership were to be dissolved, then its value would be divided between the partners according to their interest in the firm, rather than to the individual partner whose savings were used to purchase it. The importance of this was highlighted in the case of Jack v. Jack in 2016. In this case, it was held that although the land in dispute was not referred to in the partnership agreement, that it belonged to an individual partner, it was also not shown in the balance sheet or in the partnership accounts, and so was ultimately held not to be partnership property. That being said, the matter did go to the outer house of the Court of Session, and the stress and expense of that process could have easily been avoided if the partnership agreement was framed accordingly to put matters beyond doubt. Secondly, the agreement should regulate the division of the capital and income, profit and losses. If the agreement is silent on this, then all of the partnership assets are deemed to be held in equal proportions. In reality, though, this may not be the case. This was highlighted in a case in 2014, Ham v. Ham, whereby it was held that because the partnership agreement was not sufficiently drafted to deal with paying out an exiting partner, the exiting partner was entitled to not only his capital, but his share in the entire assets of the partnership. This included the land, the stock, the plant, and the machinery. The remaining partners had to wind up the entire partnership simply to realise sufficient assets to pay out the exiting partner. The exiting partner, by the way, was the remaining partner's son. This brings us neatly on to another clause which should be included in a partnership agreement, and that's in relation to provisions on expulsion, insolvency, retirement, or death of a partner. The partnership agreement should be clear as to when or if a partner can be expelled, whether that be because of behaviour, because of their insolvency, or any other reason. And it should also cover what happens to their interest on such expulsion. Notice provisions should be included and followed correctly. This was highlighted in the very recent decision, May 2020, of Rennie v Rennie. In this case, a notice of expulsion was served on one partner by another partner. It transpired, however, that all the partners in the partnership had not been consulted and allowed the opportunity to vote on the expulsion before the notice was served. This contravened the terms of the partnership agreement between the parties, and therefore it was held to be ineffective, and the expulsion of that partner was not confirmed. The court did not hear on whether or not the partner being expelled was actually a breach of the terms of the partnership agreement, or whether what he had done would merit his expulsion. Merely this was besides the point. If the expulsion procedure in the partnership agreement was not followed, he could not be expelled. The provisions in the expulsion clause would be similar to that in the clause detailing death or retirement of a partner. Whilst one is particularly or perhaps contentious, the other may not be. The agreement should contain provisions for valuing the exiting partners in each of these circumstances. This might either be on their book value, as provided for in the latest set of accounts, or it may be that their interests in the partnership be revalued at the date of exit. In the case of Mr. Ham Jr., who we've previously seen, he would certainly wish for his share in the partnership to be revalued at the date of his exit. However, the converse can perhaps be said for his poor parents. If the farmland is included in the partnership's balance sheet, then this will also form part of the partner's interests in the firm. It will therefore considerably increase the value of the exiting partner's interest. Accordingly, careful consideration should be given in each partnership agreement to reflect the agreement between the parties at that time. Particular consideration should be given to reflecting the assets owned by each partner in the agreement, alongside how these should appear on the balance sheet. In addition, it should be borne in mind whether provision for an exiting partner's share in the partnership to be paid out over a number of years is required to ensure that the business could carry on in the interim. As highlighted, the agreement should be reviewed regularly and kept up to date. There are countless times when we've been asked to provide a view on partnership agreement clauses that are simply out of date or do not serve the purpose for which they were intended. As circumstances in both the business and the family change, so should the partnership agreement. Now, the second means by which a partnership can be formed, even without a formal partnership agreement, is simply where two or more people carry on business together. This creates a partnership at will and is governed by the Partnership Act 1890. This means that the partners will not have any carefully considered clauses to fall back on in the event of a fallout between them. A partnership governed by the 1890 Act alone may be dissolved by any one of the partners at any time. If relations are hostile, then this may simply just lead to court action to resolve any dissolution agreements. Likewise, the only provision for expelling a partner on behavioural reasons is to dissolve the partnership if agreement cannot be reached. This puts the misbehaving partner in a better position than they would be if there was a partnership agreement to prescribe the method for expulsion. I've acted for two separate clients recently who each had a particularly acrimonious relationship with their brothers, who incidentally were the partners in their partnership. In each case, the partnership agreements were unfortunately woefully out of date and unhelpful in deciding how to deal with the exit from the partnership. Without going down the route of taking court action, agreements were entered into governing each partner's exit from their respective partnerships. Such agreements detailed how land, stock, plant and machinery, including basic payment scheme entitlements, were to be split between each party, with payment provisions included for any shortfalls. This exercise for each client involved tax, accountancy and valuation advice, and for one, unfortunately, required a loan to be taken out over the farmland to ensure that there was sufficient capital to buy out the exiting partner from the business. If parties cannot agree terms such as this, then an alternative solution to resolving such a dispute would be to go to arbitration to seek to have the proper meaning of an ambiguous clause determined. Often, partnership agreements will have a clause requiring partners to go to arbitration to resolve differences, and such a clause is contractually binding on each party. So other than arbitration and coming to agreement, the other remedies in determining partnership arguments are simply through the court. One particularly difficult partnership dissolution we advised on recently was in relation to a father, son and daughter-in-law who were all in partnership together. The relationship between them had broken down to such an extent that not only was the business suffering, but so were the partners' health and personal lives. The partners for whom we acted took the monumental decision to apply to the Court of Session to have the court appoint a judicial factor to wind up the firm. A judicial factor will essentially step into the shoes of the partners and take control of the business, either operating it by making all necessary decisions or, in the more likely event, wind it up, sell its assets and distribute the net proceeds between the partners. This is what happened in this particular case. Our clients did consider resigning from the partnership, but unfortunately the partnership agreement provisions in respect of how a departing partner's interests were valued were unfavourable. This is compared to actually obtaining the market value of the partnership assets themselves. So they decided against going down enforcing the partnership agreement route. Instructing a judicial factor is a way out for any partner who is in a difficult position, but heed the warning that this option should only be exercised if the partner has the appetite to see it through and is willing to take the risk. A relatively well-known partnership in Aberdeenshire appointed a judicial factor to wind up their business when the four brothers involved could no longer work together effectively. The judicial factor was appointed in or around 2007, so about 13 years ago, and it wasn't until 4 years after that, around 2011, that an agreement was put into place between the partners, dividing some of the partnership assets. Thereafter, the remaining disputed assets were placed on the open market for sale to wind up the partnership. Matters in this case, so far as I'm aware, have still not been concluded, and the partnership is still yet to be fully wound up 13 years after a judicial factor was appointed and 9 years after agreement was sought to be reached. An alternative option, which to some of our clients seems to be the most controversial and undesirable option, is to have the open and frank conversations with the partners. This is to ensure that everyone is on the same wavelength. If they aren't, then nipping any issues in the bud at the outset will certainly avoid the need for future litigation. From all of this, I do have some good news stories during this webinar, in that we have acted for a number of families who have taken great care and consideration in the management of their farming business to ensure transparency between each of the partners, but also transparency to the non-farming close family members who may also be affected. This effective planning, consulting and consideration will hopefully pave the way for future generations to come and avoid the need for any falling outs or litigation arising therefrom. Having clear, concise and up-to-date partnership agreements should be the first and foremost priority to ensure a smooth running of the business, no matter what further hurdles are thrown at the farming industry's way. Many thanks for tuning in this morning. That concludes my comments on partnerships, how they are created, how they are potentially dissolved, and how any remedies can be made. Please feel free to get in touch with any queries or questions you may have, and we'll be back next week on the 8th of July when Elaine and Steph will take the reins again to discuss whether or not possession is actually 9/10 of the law. Many thanks.